So imagine trying to save money when, the costs of your basic groceries, your electricity bill, and your rent are all just going up by 20% every single year.
Oh, man. Yeah, it sounds completely impossible.
Right. I mean, it really does. And if you're listening to this deep dive right now and looking at your bank account, feeling that exact pressure, you are definitely not alone.
Absolutely not alone.
Because earning a relatively low salary in a brutal economy, well, it feels like a solid reason to just give up on the idea of wealth entirely.
Right.
But according to the research we're unpacking today, having a low income isn't a reason to avoid investing. It's actually the exact reason you absolutely must invest.
Yeah. And that's a really profound shift in perspective. The sources we're working with today, they don't take place in some theoretical, perfectly stable economy.
Yeah, not at all.
They're specifically examining the financial realities of average lower income earners in places like Pakistan and India right now.
Right, where things are tough.
Exactly. We're talking about environments where the cost of living is genuinely punishing. Places where inflation has completely shattered that 20% mark recently.
It's just wild to even think about.
It is. And in that environment, the conventional wisdom of, just work hard and keep your money under the mattress, it completely falls apart.
Well, yeah, because the mattress money is actively rotting away.
Exactly. You're losing money just by holding it.
Right. But before we get into the mechanics of investing and fighting that inflation, we really have to look at why people's accounts are draining in the first place.
Yeah, the root of the problem.
Because the source points out this fascinating, almost tragic paradox. Even when people finally get that raise they've been desperately working for, they still end the month with zero savings.
Or sometimes even more debt, which is crazy.
Right. So, okay, let's unpack this. Why does that happen?
Well, it's a phenomenon known as lifestyle inflation. And I'd argue it's probably the biggest trap in personal finance.
Oh, for sure.
The source gives a really practical example. Let's say you're earning $30,000 a month, and you finally get a promotion that bumps your income to $50,000.
Which is a massive percentage jump.
Huge. Psychologically, you feel this surge of relief. You feel richer. But then, almost unconsciously, your baseline for what is normal just shifts.
You start eating out just a little bit more often.
Yeah, exactly.
You justify buying the premium brand of coffee instead of the generic one. Or maybe you upgrade your phone because, hey, you earned it right.
Right. You feel like you deserve it. And suddenly, that extra $20,000 is completely absorbed into your daily life.
It's literally just gone.
Poof. And it's rooted in something called Parkinson's law. Originally, that stated that work expands to fill the time allotted for it.
Oh, right. Like if you have a week to write a paper, it takes a week.
Exactly. But the financial equivalent is that expenses invariably expand to consume the available income.
Wow.
If you have the money sitting in your checking account, your brain will find a creative, totally rational sounding way to spend it.
That is so insidious. I mean, it's basically like trying to fill a bucket with a hole in the bottom.
That's a great way to put it.
No matter how much water you pour in, if the hole just keeps getting bigger, the bucket stays empty.
What's fascinating here is how automatic it is. The source highlights that unless we consciously interrupt this behavioral pattern, the default outcome for a human being is always to end up at zero.
Yeah, and social pressure plays a huge role here too, right?
Oh, a massive role. Especially in the regions our sources focus on, there's immense pressure to visibly display that you're doing well.
Like through big weddings or nice dinners?
Exactly, or the clothes you wear. It takes a conscious, almost rebellious act to say, no, my income went up, but my lifestyle is going to stay exactly the same for a while.
Which brings up the big question. How do you actually interrupt that pattern? Because willpower alone clearly does not work.
No, willpower is finite.
Right.
Go.
So what does this all mean? The source offers a mechanical solution, a rule that sounds simple on paper. Pay yourself first.
Yeah, pay yourself first is basically a fundamental resequencing of your financial life.
Okay, break that down for us.
Well, most people pay their rent, buy their groceries, pay their bills, and then if there is literally anything left over at the end of the month, they try to save it.
But because of that lifestyle inflation we just talked about, there's never anything left.
Exactly. So paying yourself first means the absolute second your salary hits your account, you take a percentage out. The source suggests 10%.
Okay, so if you earn $40,000, you immediately move $4,000 into a completely separate account.
Right. And you do this before you pay a single bill.
Wait, let me just stop you right there.
Uh-oh, here it comes.
Because I can hear the listener shouting at their device right now. If I am living paycheck to paycheck in an economy with 20% inflation, every single dollar is already spoken for just to survive.
Yeah, I hear that.
Taking 10% out right away feels like, I won't make rent, or I won't be able to buy enough food for the month. How does the source expect people to actually survive that kind of immediate cut?
Look, it's an incredibly valid pushback, and it really highlights the painful reality of this economic environment. But here's the mechanism behind why the source insists on it.
Okay.
If you wait until the end of the month, that $4,000 will inevitably get absorbed by micro expenses.
A slightly more expensive meal, an impulse purchase.
Exactly. And you still won't feel like you have enough. But by forcing the constraint at the very beginning of the month, you force yourself to adapt to a slightly tighter budget.
So it's deeply uncomfortable at first.
Oh, it's painful. But humans are highly adaptable. You'll figure out how to live on the $36,000, just like you figured out how to live before your last raise.
So you're basically artificially shrinking your own hard drive so the software can't bloat.
That's a perfect analogy. And that 10%, that's what builds your emergency fund.
Right, the moat.
Yes. The source emphasizes targeting 3 months of living expenses. So if your monthly expenses are $30,000, your ultimate target is a $90,000 reserve.
Okay, $90,000 is a huge mountain to climb when you're only saving $4,000 a month.
Yeah.
That could take 2 or 3 years to build.
It absolutely could. And that's why we have to manage our expectations here. You don't build this overnight,
Right.
But what you are building is an essential psychological safety net. It's a moat around your financial life.
Let's talk about that moat, because a moat isn't just like a puddle of water, right? It's a defensive structure designed to keep invaders out. What exactly are we defending against here?
You're defending against the catastrophic cost of unexpected emergencies.
Right.
Because if you don't have that cash buffer and a medical emergency hits, or your car breaks down, or you experience a sudden job loss, what happens?
You're forced to rely on debt.
Exactly.
Yeah.
And the source specifically warns against the modern invaders trying to cross that moat. High-interest debt traps like credit cards and buy now, pay later apps.
Oh man, the buy now, pay later apps are absolutely everywhere right now. Every single time you check out online, there's a little button offering to split a simple purchase into 4 easy payments.
And they're engineered to be psychologically dangerous, especially for lower income earners.
How so?
Well, they mask the true cost of an item. By breaking a $10,000 expense into smaller 2,500 chunks, they bypass the pain center in your brain that usually triggers when you spend a large amount of money.
So you feel like you could afford things you actually can't.
Precisely. But what you're really doing is trapping your future cash flow.
Yeah.
You're guaranteeing that next month's salary is already spent before you even earn it.
Wow.
So the emergency fund prevents you from falling into that toxic debt spiral. It ensures that one single crisis doesn't wipe out years of your progress.
Okay, so we've stopped the bleeding. We're snatching that 10% away immediately. We're adapting to the artificial constraint. And we're slowly digging out that defensive moat so we don't have to rely on toxic debt.
Right, that's the defense.
But saving cash alone isn't enough, is it? Especially with that brutal 20% inflation figure hanging over our heads. How do we actually go on the offense?
Yeah, this is where we really have to demystify investing. Because the source shatters a massive cultural myth right out of the gate.
The idea that you need a fortune to start.
Exactly. Or a degree in finance.
Yes. The source explicitly states that you do not need a Wall Street salary. You can start investing with as little as $1,000 to $5,000.
Which is so accessible.
It is. But before we talk about where to put that money, we need to clearly explain the mechanism of inflation, because it's the entire reason investing is mandatory.
Absolutely. Think of inflation as a silent thief that just visits your bank account every single day.
Okay, let's hear the math.
Let's say you have $1,000 today, and a bag of rice costs $10. You can buy 100 bags of rice.
Simple enough.
But if inflation is running at 20%, next year that exact same bag of rice costs $12.
Right.
Your $1,000 hasn't changed. The bank still says you have $1,000. But now you can only buy about 83 bags of rice. You literally lost 17 bags of rice just by letting your money sit there.
Your purchasing power is literally evaporating. So if your money isn't growing by at least 20% a year, you're effectively taking a pay cut.
Exactly.
Here's where it gets really interesting. That leads us to the investment vehicles the source recommends for beginners to fight back. It breaks down 3 main options: mutual funds, the stock market, and gold.
Right.
Let's start with mutual funds, because the source highly recommends them, citing historical returns of 10 to 15% annually. How exactly does a mutual fund protect a beginner?
Well, it really comes down to professional management and diversification. If you only have 1,000 to invest, buying stock in just one single company is incredibly risky.
Because if that company fails, you lose everything.
Exactly. But a mutual fund pools your 1,000 with money from thousands of other investors. Professionals take that massive pool of money and buy tiny pieces of hundreds of different successful companies.
I like to think of it like trying to ship your cargo across the ocean.
Oh, I like that.
If you put all your cargo on one single ship and it hits a storm, you are ruined. But a mutual fund takes your cargo and spreads it across 500 different ships. Even if one or two sink, the vast majority make it to port and your overall wealth grows.
That is a perfect way to look at it. You're buying a slice of the entire economy's growth rather than betting on a single horse.
Okay, what about the stock market itself?
Now, the source also discusses directly investing in the stock market, which historically can yield 12 to 18% long term. But, and this is a big but, it comes with a massive flashing warning sign for beginners.
Absolutely, avoid short-term trading.
Yes, avoid it like the plague.
Why is short-term trading so dangerous if the market generally goes up?
Because in the short term, the stock market is entirely unpredictable. It's driven by news cycles, panic, and emotion. Over a single week or a month, a stock's price is essentially just a coin flip.
And if you need that money next month, you might be forced to sell it at a massive loss just because the market had a bad week.
Precisely. But over 10 or 20 years, the stock market reflects the actual fundamental growth of human innovation and corporate profits. That time frame smooths out the volatility.
And then there's the third asset, gold. This presents such a fascinating contrast. On one hand, you have the stock market, which is this modern, dynamic engine of corporate growth. And on the other hand, you have gold, which is basically an ancient, heavy anchor.
Yeah, the source categorizes gold strictly as a safety asset. It's crucial to understand that gold does not produce anything.
Right, a company invents new products and pays dividends. Gold just sits there.
Exactly. But what gold does exceptionally well is hold its value relative to inflation over long periods. It provides stability to a portfolio, not aggressive growth.
So if your currency is collapsing due to that 20% inflation, gold is a way to freeze your purchasing power in place.
Yeah.
But here is the massive realization from the source material. We've spent all this time talking about where to put your money funds, stocks, gold. But if you are on a low salary, there is a hard mathematical limit to how much you can squeeze out of your budget.
Oh, absolutely.
You can only cut your expenses down so much before you hit the absolute floor of basic human survival.
Which is why the source drops a brilliant pivot. The single highest return investment you can make on a low salary isn't a financial product at all.
It's not.
Nope. The best investment is in your own human capital, your own skills.
Investing in yourself. The source lists high leverage skills like freelancing, video editing, learning to use AI tools, or content creation.
Yeah.
And the logic is so bulletproof.
Yeah.
Your expenses have a floor, but your income potential has a much higher ceiling.
Exactly. Especially today in a digital borderless economy where a skill like AI prompting or video editing is in massive demand globally, regardless of your geographic location or local currency.
It's the ultimate lever.
It really is, because when you increase your income while simultaneously keeping your expenses in check, meaning you successfully fight off that lifestyle inflation we talked about, saving and investing suddenly transforms from a painful daily struggle into something drastically easier.
You essentially widen the gap between what you earn and what you spend.
Yes, widening the gap is everything.
And when you combine that newly widened gap with the mathematical phenomenon of compounding, the results are genuinely shocking.
They really are.
The source gives a very clear numerical example. If you consistently invest just $5,000 every month at a 12% average return, in 5 years, you yield around $400,000.
That's already amazing.
But if you keep going for 10 years, it crosses over $1 million.
That is the raw power of compounding. Most people understand simple interest. You get paid a little bit on your initial investment. But compounding is when your interest starts earning its own interest.
Right. I always think of it less like a bank account and more like planting an orchard.
Oh, go on.
In year one, you plant a few apple trees. You do a lot of work, you water them, and they yield just a few apples.
Yeah.
But you take the seeds from those apples and plant more trees. By year 5, the trees you planted in year 1 are massive, dropping hundreds of apples, all of which contain seeds.
It starts scaling up.
Exactly. By year 10, the orchard is literally planting itself. The growth becomes exponential. But There's a huge behavioral catch to this, isn't there?
Yeah, this raises an important question. The catch is patience. The mathematical curve of compounding is incredibly flat for the first few years.
Because you're putting in $5,000 every month, and for a long time, it just looks like you have a little bit of savings.
Right. You don't look rich. You don't feel rich.
It reminds me of the gym in early January.
Oh, the New Year's resolution crowd.
Exactly. Everyone starts off so strong. They buy the new shoes, they go 5 days a week, they look in the mirror after 2 weeks, see no massive difference, and by March, the gym is completely empty.
Yep.
People do the exact same thing with investing. They get excited, put away a chunk of money, check their portfolio every day for a month, see it hasn't doubled, and they quit.
It is exactly like that. We're just culturally wired for instant gratification. We want the overnight crypto success story.
Totally.
But the source is advocating for something much deeper. Relentless consistency and deep patience. You have to synthesize these two distinct timelines perfectly,
You actively hustle in the short term to increase your income through new skills.
while simultaneously letting the compounding do the heavy, silent lifting in the background over the long term.
It really is a complete sequence of defense and offense. If you're listening to this and looking at your own financial landscape, it really comes down to these distinct moves.
Just 5 core takeaways, really.
Right. You play defense by snatching that 10% away immediately, forcing yourself to adapt so you can build that 3-month emergency moat.
You defend those walls by refusing to fall for the toxic psychological traps of buy now, pay later schemes.
And then, once your castle is secure, you play offense. You stop letting inflation steal your purchasing power by starting small, moving your money into diversified mutual funds or stocks.
And most importantly, you aggressively upgrade your own skill sets to raise your earning ceiling.
It's a highly practical, stress-tested blueprint.
It is. And as you take this knowledge forward, listener, it's vital to remember that true wealth isn't built on a lottery ticket or a lucky stock pick or, getting rich in 1 month.
Definitely not.
It's built through long-term thinking and disciplined, quiet habits. It's about taking back control of your financial destiny, step by deliberate step, even when the broader economy feels terrifying.
Taking back control is exactly what this is about. But before we wrap up this deep dive, there is one final provocative thought I want to leave you with. Something to mull over on your own that builds on everything we just discussed.
I like where this is going.
We saw the mathematical proof from the source of how powerfully money compounds over a decade, right? We know that putting away just $5,000 a month can turn into $1 million through the compounding of interest.
Yep.
But think about this. What happens if you apply that exact same law of exponential compounding to the skills you learn?
Wow.
If you take just 10% of your free time, starting today, and invest it into learning AI or coding or advanced video editing, how exponentially will your personal human capital compound over the next 10 years?
Now that is a compounding curve that could change absolutely everything.
Keep building your moat, keep planting those seeds. Thanks for joining us on this deep dive.